There's one word since late 2021 that I heard more often than ever before: inflation. We usually want a 2% inflation rate in the euro area. Last October it was 4%, 5% last December, almost 6% in February, and last month inflation was the highest in about 40 years, 7.3%. 7.3% price increase year over year, all while our savings at euro bank accounts still return zero. That's not good. It's pretty bad actually, because it means that you are losing a guaranteed 7.3% of your hard-earned money every single year when inflation is that high. So let's see the top 5 to-dos how you can protect your hard-earned money and how you can even profit from this high inflationary environment, ranked from worst to do to best to do. What's up everyone? Welcome to a new video from PerFinex, the #1 English-speaking and independent financial planner in Germany. My name is Axel and today I am PerFinExplaining inflation and what you can do against it. About 2 years ago we published this video, PerFinExplaining inflation already. The channel has come a long way since then, and so has inflation. So I don't need to explain that to you anymore, do I? With inflation being at record 5%, 6%, 7%, you know damn well the prices are increasing and everything is getting more expensive, meaning you can afford less and less with your money. And while most people are crying about this high inflation, others are making a lot of money out of the current situation. Can you profit from inflation as well? Yes, you can. So let's start with the to-do that has the least impact on your inflation and come to the to-do that will make you love inflation, because you're profiting tremendously from it. To-do number 1, with the least amount of impact on your personal inflation rate: adjust your consumption. What we first of all need to understand is that the official inflation rate is only an estimate for an average consumer, and everybody watching will probably have a slightly different inflation rate. Here's the average German basket that leads to the 7.3% inflation rate in March. The average person in Germany spends about 20% on cold rent, so this person probably doesn't live in the top 7 cities, 13% on mobility, and 0.6% on beer. This person is definitely not living in Munich. The official inflation basket is linked in the description, so you can check it out yourself. When looking at this bubbly circle, you will probably find out real quick that this official inflation basket is a lot different than your personal spending habits. We got you covered. Well, actually, the German Federal Statistical Office got you covered with their personal inflation calculator that is also linked in the description below. You can type in exactly how much you spend on food, rent, mobility, and lifestyle and calculate your personal inflation rate. I did it myself and got a 5.8%. Now that's a lot better than the official 7.3% inflation, but still quite a lot. 5.8% inflation rate means 100 euros of my hard-earned money is worth only 94 euros after 1 year, 75 euros after 5 years, and 57 euros if this inflation would continue for 10 years. I think we can all agree that we need to do something here. Most obviously is to adjust our consumption. Here are the most noticeable price changes in Germany from March. Oil, gas and diesel are the top 3 that got most expensive. Oil even doubled compared to last year's March. And software and seniority homes got cheaper. So sell your car, stop using oil, rather use more software and move into a seniority home. And ta-da! Your inflation rate will be a lot less than before. But that only gets you somewhere, right? So let's look at inflation to-do number 2. Buy real assets like gold or silver. If you look at why we even have inflation, there's only one solution, and that is to buy real assets. And if you've seen a couple of our videos, you know that I'm a big why guy. So why do we even have inflation? Of course, in times of war, there has historically always been high inflation. That's correct. But arguably the biggest reason why we have inflation is that central banks around the world have been printing money like crazy over the last years. especially over the last 2 years. Here are the balance sheets of the American Federal Reserve and our European Central Bank. Both have been printing money since the global financial crisis in 2008. But look at the last 2 years since the start of the pandemic. Both central banks went from about 4-5 trillion in assets to 10 trillion in assets. 10 trillion. Let's digest what this means. If we were at 5 trillion in 2020 and 10 trillion today, then every second euro or US dollar is younger than 2 years. The European Central Bank doubled its balance sheet and created twice as many euros as there were 2 years ago. No wonder there's a massive inflation now, right? So the solution and the basis for our inflation to-dos is to change money that can be printed into something that cannot be printed, like gold or silver. As both cannot be created in a central bank computer but have to be mined out of the ground, in theory both should rise at least with inflation, right? And that's kind of what happened. Since the inflation rate spiked last year, both were up pretty good in value. My personal issue with the price increase is, first of all, and you guessed it, past performance is no guarantee for future results. And second, precious metals do nothing except shine. They are unproductive assets that do nothing except lay around looking good. Just like, whoops, we better cut that out. Another asset that cannot be printed is inflation to-do number 3, cryptocurrency. A perfect example is Bitcoin, which has its hard cap at 21 million. And luckily, no central bank has the power to create more supply. And since I mentioned it here as a possible solution against high inflation, I want to address this comment before all of you go out and buy cryptocurrencies, thinking this will solve all your problems and make you rich overnight. Because you guys and my students told me for crypto about years now. I was looking into it last Christmas and now I understand the value behind the blockchain technology. That's also why I want to use the advantages of the blockchain in my newest business idea, GermanReal.Estate. Check out this video if you are interested to see how we can invest in real estate for just €1 single using the blockchain. Link is in the description. Does that make me pro-crypto now? Nope. I understand the great value behind the blockchain technology, but I still think that at least 90% of crypto will go away after the speculators and the scammers are done. Just like in the beginning of the 2000s, 90% of email providers, search engines and social networks gave up. But even if, with almost 19,000 different cryptos listed on CoinMarketCap, that means that even if 99% would go away, 190 cryptos would survive. So if you are interested in crypto and also want a credit card that pays you up to 8% cashback, check out this video that includes a €25 bonus for you if you sign up for one of the largest crypto providers, Crypto.com. The issue with the prior inflation to-dos is that both are unproductive assets, right? So let's come to the productive assets with inflation to-do number 4, stocks and bonds. Stocks or ETFs or mutual funds with stocks inside are a little more straightforward, I feel. High inflation comes from companies raising their prices, and good companies usually grow. That's why stock prices also grow over time. It's just important that your stocks or ETFs grow higher than inflation. If your return is 7% and inflation is 7%, you are basically at zero. Actually even worse, because you have to pay capital gains tax on your 7% return. That's why you want investments that can outperform inflation, and productive assets like stocks or bonds that pay dividends or interest can do that. You can make a profit from buying an investment here and selling it here, as well as passive income from the dividend or interest payments while you hold that asset. So much for the stocks. Bonds are a lot more interesting right now because the American Central Bank, Federal Reserve, already announced that they will raise interest rates in response to the high inflation. And everyone is waiting now what our European Central Bank will do. Historically speaking, a 1% change in interest rates means a 7% change in bond prices, kind of like a seesaw. If interest rates rise by 1%, bond prices usually fall about 7%. If interest rates go down, bond prices go up, which they kind of did over the last years, and that's why bonds return so little. The next few years will probably be interesting. On the one hand, bonds will return a higher passive income when interest rates go up, which is good. On the other hand, bond prices will probably fall when central banks start raising interest rates. So if you would like to invest in the best way possible through these interesting times, check out our Investing in Germany series as well as our community investing that we publish every first Friday of the month. We also have a safe investing strategy that invests about 75% in global bonds. You know what bonds actually are? Debt. And inflation is good for everyone with debt. If 7.3% inflation means your money is worth 7.3% less than last year, that also means that your debt is worth 7.3% less than last year. So if you want to be the real winner from the current high inflationary environment, get some debt and do something clever with the freshly borrowed money. And how do you do that? With inflation to do number 5, real estate. Inflation is great for everyone with debt because inflation devalues your debt every single day. But you need to do something meaningful with your borrowed money. I'm not talking about getting a consumer loan and spending it on stupid stuff. I'm talking about using leverage here, because leverage turns good deals into great deals. The Postbank study shows that real estate prices in Germany rose on average by 9.6% in 2020 after inflation. And as people usually use leverage with super cheap bank loans to buy properties, your return on equity is a lot higher than just 9.6% after inflation. And you're not even taxed on the profit if you're not selling, or if you sell the property after the speculation period of 10 years. Sure, interest rates are a lot higher than they were last year, but hey, if you're a real estate investor, you can deduct interest rate you have to pay to the bank from your taxes. So it's not that bad. If you are interested in real estate in Germany, then check out our video series on that. We published 13 videos on that already, and there's a lot more to come. So stay tuned for that and make sure to tune in next week when we kick off tax month with 4 tax videos in May. Happy weekend, guys!